that reminds me of something I wanted to get your opinion on, and it's this 60-40 portfolio that every single financial advisor in the whole wide world tells their customers or their clients that you've got to get in. And what really irritates me about that is that they'll only go back to 1981. Of course, there's cherry picking. Bonds, the price of bonds and equities have all just kind of gone up in almost a straight line when you look at them in nominal terms. And, they just kind of, forget about the 70s, 60s, 50s, 40s, forget about the 60 years prior to that. But how do you see kind of the 60-40 right now? What would be, I'm assuming moving forward, if we're going to a stagflationary environment, that, the 60-40 is not what people want to be in. And Chris Cole, his great paper confirms that. But how do you see the 60-40, and what advice would you give to just the masses, the 99% of the people out there that are positioned this way?
Well, let's just make it real simple. I mean, 60-40 is a static position. Everything we're trying to invest in, the economy, markets, asset allocations, is nonlinear and dynamic. Why would you have a static solution for something that's linear and dynamic, or nonlinear and dynamic? Why would you do that? That's the first question. Like, you just know you shouldn't be doing that anyway. Now,
intuitively, right.
Now, if I have 4 economic quadrants and I have 4 different portfolios for 4, think of it like the weather, and a lot of our clients think of it that way too. Quad 1, 2, 3, and 4 are like the 4 seasons. When winter is coming, why would you hold the same position? I mean, sometimes the position is to have 90% treasuries and 10% dollar and nothing else. That's quad 4. You will beat everybody when you hit quad 4 when winter is coming. So it's not just not 60-40, it's actually using, God forbid, you're being data dependent and flexible. And now what I love about it, George, is that there was a time not so long ago that it would cost a lot to pivot your 401ks or your Roth or whatever, wherever you have your retirement money. But now you don't have to pay commissions on ETFs. Right. From a macro top-down perspective, there are 174 ETFs, and I pay 0 commissions on changing my setup. So again, the setup can be a variety of different setups. What I like to say, again, instead of 60-40, we have 4 major asset classes, let's just start with to begin with. You got foreign currency, fixed income, equities, and commodities. That's just to start. And when I put Bitcoin and commodities, maximalists lose their minds. I also have wine, art, in the commodity bucket. And I put basically, not to go through the whole thing, but there are peak positions by asset class. You can have a cocktail of many different permutations of asset allocation depending on what your risk tolerance is and what you're interested in. But just being in equity and fixed income, that's equally stupid. I mean, why would you do that? You're missing out on huge US dollar moves in the foreign currency market and or dollar drawdowns, which make other foreign currencies very interesting investments. And you're missing out on entire asset classes like commodities, which include new and dynamic things like Bitcoin.